those people that have maybe never bought a house before, or it's been a while since you bought a house and you want to know what products are out there for you to use so that you can ask the right questions when you're speaking about the financial piece of purchasing a home. And you'll hear things like FHA loan, VA loan, and USDA loan, or conventional loan, non-conforming loans, all those different things. And sometimes you're like, well, what is that and how does that help me and when I'm trying to purchase a house? We want to break those down in segments. And so today, me and Eddie are going to touch on the FHA loan, which is the Federal Housing Administration loan. It's a privilege to have Eddie, who's been in the game for a while, to be able to expound on the specifics and how they can benefit you if this is the loan that you so choose to use. Eddie, what's up, man?
What's happening, Corey? How are you doing?
I'm good. I'm excited about this one. This is one of the ones that most people hear about, and sometimes the way it's advertised is a little funky because you don't get the full picture. But FHA loan, man, what is it?
An FHA loan is a government loan backed by Federal Housing Administration. Qualifications and requirements may vary, but what we're going to cover today would generally apply across the board. Typically, with an FHA loan, your minimum credit score requirement is going to be 580. Now, when I say score requirement, we're referring to your middle credit score. Most of us would have 3 credit scores. That's with each bureau. You've got your Experian, TransUnion, and Equifax. When I say middle score, that's numerically speaking. So let's say that you have a 580, a 650, and a 720. In that particular case, 650 would be your qualifying or middle credit score. If you're dealing...
Let me ask you this to cut you. I didn't mean to cut you off, but how is it when those people come to you? Hey, my Credit Karma is saying that I have a 660, or whatever third party that's told me that, oh, my credit man is a 645. Is that something that y'all use, or is it something you're looking at?
Most credit monitoring websites like Credit Karma and all these different companies, they are using what's called a Vantage scoring model. It is not typically going to be the same scoring model that most lenders are going to use. Most lenders are going to use a combination of your FICO. And very rarely are you going to find that online credit monitoring site is going to match what your actual lender is pulling for your credit scores. When people hear that, they get a little frustrated. They're like, well, what's the point in having credit monitoring? Credit monitoring can still be quite valuable, because although the scores are not going to match exactly what your lenders are going to pull for you, the information as far as accounts, balances, payment history, all of that stuff should match. So if Credit Karma is showing a particular balance or late payment history, that should be across the board. Anybody pulling your credit is going to see that same information. Generally speaking, if you see an improvement on your Credit Karma report or on your myfico.com report, then that should improve across the board. Will it show the same scores? No, but if your score is going up in one place, then the scores should be going up in every place.
I have used myfico.com. Myfico.com has been probably the best thing as far as the closeness and accuracy to what that final score is. And if you have the paid service, depending on what kind of plan you are, it just keeps you updated on what's going on as you are making transactions. So one thing to note, not a plug for them, but I'm just letting you know what has
No, absolutely. It's probably now more important than ever that you keep your thumb on the pulse, whether or not you're in the market to purchase a home. You just want to always be monitoring what's happening on your credit, because it's constantly updating. Credit Karma is free, last I checked. And then there are paid services. And also, if you have a credit card, or depending on who you bank with, you'd be surprised at some of the benefits that you have with your credit card that you can take advantage of. Anyway, back to FHA loans. The minimum score requirement is generally going to be 580. We can go as low as 500, but that would require a manual underwrite, which I'll get into in just a second. Your loan limits. Every year, FHA updates the maximum allowable loan limit. The current Texas standard max allowable loan limit for an FHA loan is $524,225. In higher price counties like Travis and Williamson, some of the more costly areas of Austin, you can go up to $571,550. These are all single family. If you wanted to get a multifamily, popularly referred to as your house hack, where you're buying anywhere from 2 to 4 units and you reside in one of those units, you can go as high as $671,200 on 2 units, $811,275 on 3 units, and $1,008,300 on 4 units. In some areas, up to $1,099,150 in high-cost counties.
Depending geographically where homes are, the loan limits serve a purpose.
Right. Loan limits vary from county to county. Generally speaking, you plan on the standard loan limit, which again is for a single family in most Texas counties would be up to $524,225. We'll post all these loan limits for you.
Perfect. The FHA loan has been known to be the lowest entry as far as down payment. And that's why we're talking about this one specifically, because it is what it is.
Technically, you have other products that can give you lower down payment options. FHA loans are popular for a number of reasons. If you're a first-time home buyer, conventional loan can get you as low as a 3% down payment. The reason why you're tend to see more FHA loans when down payment and most bang for your buck comes into play, it's going to vary on each situation. But typically, if you have someone that's below, let's say, a 690 or a 680 credit score, they're going to usually see better pricing options on an FHA loan. Assuming, of course, that we're below that maximum loan. Once you get above that 680, 690 credit score, that's where you're going to see conventional kind of edge out on the pricing options. And there's pros and cons to the different loans. Generally speaking, if you've got below a 690 credit score, your FHA loan not only gets you as low as a 3.5% down payment, but it's also going to give you a higher back-end DTI, or a debt-to-income ratio, which essentially means you can purchase more home, whereas on a conventional loan, you might be limited to 45 to 50% on that back-end ratio, which means you get a little bit less as far as your purchasing power.
So financial makeup and what that looks like makes it unique to open up doors to other options, right?
Right.
There's a choice, right?
Every situation is going to vary. And just to be clear, you don't have to have a 680 credit score to get a conventional loan. That's just simply where the pricing is going to be starting to look a bit more attractive than my FHA option, right? Now, your down payment, debt to income ratio, income, all these different things are going to manipulate those situations and possibly make one product appear more attractive than the other. Always a great idea to get in touch with a mortgage broker like myself and make sure you're getting those comparisons. If you're 8690, assuming that you want to put down the minimal amount, the loan is going to be a bit more attractive on your options than conventional. If you have more assets or more money to play with and you put down more money, then things like MI will factor, because although your pricing might not be as attractive with conventional with the lower credit scores, you will have the option to not have MI. So that would bring up future costs and things that might play into what option you want to take advantage of.
Gotcha. So you mentioned that as low as 580 credit score, but anything below that down to as low as a 500, then you have annually underwritten.
Right.
What is the change, if at all, in the down payment requirement?
Anything below 580 would require that manual underwriting. Right off the bat, your maximum LTV would be 90%. That means that it would be a 10% down payment requirement. You don't see an abundance of manual underwrites because at a 580 credit score, there's a very good chance that some bills weren't paid on time. And most of the time you see that occur, might not have an abundance of cash on hand for that higher down payment. However, it exists because there are cases where you have the down payment. If you have 10% to put down, then a manual underwrite may be an option. The next change in the requirements when you're doing a manual underwrite are your ratios. What is commonly referred to as your housing ratio would be 31% as opposed to 43%. So your typical front end ratio on an FHA loan can be 43 and sometimes as high as 45%. When I say housing ratio, that refers to your principal and interest mortgage payment, taxes, insurance, homeowners association dues if applicable. That is what would comprise your expense or housing front end DTI ratio.
When you do a front end ratio and you give that number, what is that a percentage of?
You would take your total housing expense, principal, interest, taxes, insurance, and HOA if applicable, divide that by your qualifying monthly income. With a manual underwrite, it can't be any higher than 31%. Things can vary, and that's why I mentioned those higher percentages. I've seen them work as high as 45 and 46%, but on the safe side, especially when you're in the house hunting stage, the last thing you want to do is be using a red line number and find out that the whole deal is falling apart because we were maxing everything out. So I would keep it at the 31 and 43% just to be safe. Your end ratio, same calculation, only now we're adding in your monthly debts, like your credit cards, your automobiles, essentially anything that is reporting to your credit. And in some cases, things that might not be recording to your credit, like these buy now, pay later things like Klarna and different companies doing it in installment payments of maybe 6 to 12 to sometimes 18 or 24 months. Not all of those may report to your credit, but when the lender becomes aware of them, they're going to include that in your DTI.
Yeah, you see that also on Shopify. You see it in Amazon. They give that option.
Yeah, that's a whole nother video. Those have been coming up more and more often. I'll add a link in the description where I talk a little bit more about that. But essentially, the main difference or factors that you want to look at when we're doing that manual underwrite is the reduction in max allowable ratios, as well as the minimum down payment requirement goes up from the 3.5% up to 10%. Also, there cannot be any housing or installment payments that have been late in the last 12 months. No revolving would be like credit cards. No revolving 90-day late payments in the last 12 months, and a maximum of 2 60-day revolving late payments in the last 12 months. We'll list all of that in the description below. When all else fails, if there's questions, you reach out to a mortgage broker like myself and we'll get everything clarified for you.
So we've talked about requirements as far as credit and what you can do if it isn't where it necessarily needs to be. There's still options available to the person that still wants to buy a home. What are some things that you also have to look at when trying to qualify for an FHA loan?
The 580 and above credit score, make sure that you're being mindful of your maximum allowable loan amounts. If you happen to have any issues with government debts, make sure that we discuss and get some sort of resolution or payment plan in place before we run the file, because those are some things that might not be showing on the credit, but it will more than likely show up on a CAVERS report. So we want to get that settled before running the file.
That's a big one. That's a gem that probably most people don't know until they actually speaking to a lender, or they got like, oh, I didn't know that was there, or that was going to be an issue.
and that's something that, depending on who you're working with, some people might pull your credit and they say, okay, this looks fine. They're checking all of the typical boxes, but if they had not run a CAVERS report, there could be something that pops up. If we don't identify that up front, it can kill the whole deal. And last thing you want to do is get into contract, put all your deposits, order appraisals and inspections, only to find out that something came up that could possibly hinder or kill that deal.
Good stuff. There's one particular fee that is solely to this loan, which is called upfront mortgage insurance. And I know some people ask once they see it, when they get, maybe a fee sheet or they get some preliminary numbers as to them purchasing the house, they're like, what is this? Can you help us understand what is upfront mortgage and how is that calculated?
Another big difference between FHA and your conventional loans, you're typically going to find that an FHA loan 9 out of 10 times is going to have a lower interest rate than a conventional loan. The trade-off is that an FHA loan is going to have not only MI, your monthly mortgage insurance, regardless of the amount of money that you put down, and that is typically going to be for the life of the loan. but it's also going to have what Corey's referring to, upfront mortgage insurance. That is a huge difference when you're making your comparisons that you want to keep in mind. An FHA loan is going to require upfront mortgage insurance of 1.75% of your base loan amount, regardless of the amount of money that you put down. Your monthly MI can vary depending on your down payment. You put down 3.5% and you'll have 0.55% monthly MI. You put 5% or more down, and that would drop to 0.5%. Your upfront mortgage insurance is going to be the same, 1.75%, regardless of the amount you put down, regardless of your credit score, regardless of manual or regular underwrite. You can pay that upfront, but most people opt to finance that into their loan amount. That is a benefit that although it is an additional cost, it can be financed over the term of the loan and typically is. Big difference between your FHA and your conventional loans is that generally speaking, with a conventional loan would have your MI if you're putting anything less than 20% down typically. Once you have built up 20 to 22% equity in the home, that MI would drop. With an FHA loan, you're getting that monthly MI for the duration. Until that loan is paid off, you're going to have MI. And that's kind of the trade-off. That's why in some cases you might find an FHA loan has an interest rate as much as a full percentage point lower. Same exact credit score on an FHA loan might give you as much as 1% lower on your interest rate than a conventional loan would. But that huge difference is that you're having two forms of MI. So in some cases, it might wash out that savings. And in some cases, it might be a clear indicator of, okay, this is my better loan option. It's always going to vary and you want to compare.
I appreciate you breaking that down. Now, when you hear the word insurance there, is it of any benefit to the borrower? What is that insurance for?
That insurance is no benefit to the borrower per se, because the lender is taking on this loan. This is their built-in insurance in the event of a default, which is also, again, to a lower degree, the same reason why a conventional loan would require MI. So essentially, the higher the risk in the lending would determine whether or not you have MI in the case of conventional and how much that percentage will be. So again, a big difference between FHA and conventional loan products is that across the board with an FHA loan, you're going to have both forms of MI. The only difference maker in the monthly MI would be the amount of your down payment. Whereas on a conventional loan, let's say you're putting down 3% or 5% on your down payment, but your MI could vary greatly based on your credit score, because it's also a risk-based assessment.
The FHA loan, that percentage you said is either 0.55% or 0.5. Is that dollar amount subject to change, or is that the same throughout the life?
Your score really has no bearing on that percentage. The percentage is solely based on your down payment. So if you're putting down 3.5%, your monthly MI is going to be 0.55. If you're putting down 5% or more, then your monthly MI would drop to 0.5, regardless of whether or not you had a 620 or 700 credit score. And again, that's another big difference between FHA and conventional, because on the conventional side, similar scenario, if you're putting 3% down, your monthly MI can vary greatly between a 620 and 700 credit score. You might have 0.8% or 1.2% monthly MI with a 620 or 660 credit score, whereas if you have a 700 or 800 credit score, that MI might drop down to 0.23%. Those credit accomplishments can lessen the risk of the loan, which then would also lessen the amount of MI collected.
That's a breakdown. For the mathematicians out there, for those people that like to break down and analyze the nuances of how things are calculated, one key thing to note is that the FHA loan does allow you to buy multifamily up to 4 units, right?
Yes.
So up to 4 units.
It is important to understand that all FHA loans require owner occupancy. When you're purchasing, let's say, a multifamily, and that's all government loans, period. If you're purchasing a 2 unit or up to 4 units, As long as you're occupying one of those units, then yes, you can technically purchase an investment property with an FHA loan, which is a huge benefit and a great way to immediately not only secure your owning real estate, but also income producing property.
Gotcha. Can this loan be coupled with programs that are of benefit to a borrower, whether that be down payment assistance or gifted funds from a family member? What can people couple this loan with something in order to help them get into the home?
Yes, as a matter of fact, it's one of the most popular loans to be coupled with many of the down payment assistance options. Although there are programs that couple with conventional, you'll find more times than not that down payment assistance is typically going to be more popular coupled with an FHA loan. So you can couple down payment assistance, whether it be through a second lien or a grant. There's plenty of down payment assistance options that can be coupled with both FHA and conventional, but you're going to find more times than not that the benefits will speak a bit louder and work a bit more seamlessly in most cases with an FHA loan.
Before we get out of here, what are some things that you would caution a borrower from doing prior to getting this loan finalized?
Great question. And this answer applies to any mortgage. Whenever you're looking to apply for a loan, or if you are in the process of closing a loan, let's say you've already applied, but you're just now waiting for that closing date to occur. A lot of people make the mistake of thinking, okay, well, we're clear to close. I'm good. So I can go ahead and purchase my furniture or get this new car, what have you. The first thing is hold off on making any large purchases, whether it be furniture, automobile, etc. I know there may be big sales popping up or something like that, but wait until you have your keys to make any big purchases. In the event that something absolutely has to happen, make sure that you're communicating with your realtor and your lender to avoid any possible event that could cause you to lose your approval status. I've had it happen many times throughout the years where another credit report would have to be pulled or something pops up that unveils a new debt that was opened that has now taken you from an approval status to a denial. Avoid switching jobs or employers. Avoid changing the way in which you're paid, because maybe you're not switching employers, but maybe you're offered a new position that would change you from being a salaried employee to making commission. And sometimes people might think, well, yeah, I'm going to change the way I'm going to get paid, but I'm going to make much more money. That may be true, but the moment you've changed the structure in which you are paid, that could change the way that we have to calculate your income, right? So if you're on a fixed salary, that's a no-brainer. And we've already done that. You're already approved. So let's hold off on changing anything about the way that you're paid. Now, there are rare cases in which time is of the essence. So always bring that information to your mortgage broker and discuss it before anything is done to avoid any mishaps occurring. So let's see. Avoid making any big purchases, avoid any job changes or employment changes or how you're paid. Avoid having people pull your credit. Right? Sometimes you might think, okay, well, I'm not going to make a big purchase, but I want to have everything mapped out, right? So let me apply for this and see what my financing options might be on the automobile or be on this furniture. It might sound harmless enough, but pulling that credit could actually reduce your credit score. And in the event that they may need to pull your credit again, and that could impact your qualification. So those are the three big things that I would avoid: making any large purchases, any changes in your employment or income, and avoid just having anybody pull your credit in general. Always wait until you have your keys. And in the event that something has to happen, just make sure that you consult with your mortgage broker to make sure it's not going to cause problems.
Perfect. Eddie, I thank you for your time. I thank you for answering these questions. Please, people, comment below. This is what Eddie does full time. He is a mortgage broker, so he can assist you in all things mortgage. We appreciate your time today. If you're in the market, you're looking for a home, and you got questions or you want to know what your financing options are, feel free to reach out. The contact information will be below. And of course, I'm the boots on the ground. I'll be able to help you search and look for anything that you're looking for. And I can work with Eddie to make sure that we are being very efficient in what we're searching for, and we're matching up your needs with your desires. Take this information, use it, and let's make the best decision for yourself. Eddie, can you tell them where you can find you?
Yeah, absolutely. Across most social networks, you can find me at HomeEcNet or H Mortgage. We're going to post links in the description for both Corey and myself, or you can always give me a call directly at 281-304-6353.
And of course, you can find me anywhere, Corey Real Estate Guy, social media wise, and I'm at your service. Eddie, I appreciate you. The market is still moving. Houses are being sold each and every day. There are transactions and closings happening every single day. So get out there and take advantage. Now may be a prime time since we are moving into the latter months of the year, and there's still a bunch of inventory on the ground. There are still people making deals for whatever reason, especially in new construction. So find a house. Find you something that you can get in for a lower barrier to entry, and let us help you make that move.
Absolutely. Thank y'all for tuning in, and feel free to give us a shout if there's anything else we can help with, and we'll see y'all in the next video.
Peace.